As always, markets give us plenty of reason to analyze and talk about all that's going on. And to do just that, we've got Rajat Rajgarhia joining in from Motilal Oswal. He's the head of research. Rajat, thanks so much for being with us. Thank you for taking out the time. So let's just start by understanding what you have made of this wild ride, the volatility, and the fact that we are still somehow just holding on to 50 to 100 by the skin of our teeth. Do you think this is some kind of beginning of a bottom formation? Your thoughts on the market the week gone by?
Yeah, I think at least we ended the week on a positive close, but all the events which have led to this kind of a fall in the markets, they remain in place. You saw the IIP numbers coming today, which were 1.5% growth. So it's a second consecutive month where the growth is very low single digit. And I think you are going to see moderation in growth estimates of everyone for both 4Q, FY11 and FY12 as far as the macroeconomic parameters are concerned. Second, the events which are non-earnings related, which are more relating to all the issues that we have seen over the last one quarter, those events persist. And I think if you look at the sequence of turns which have happened over the last 1 to 2 weeks, the media has kept on speculating, or at least they've kept on quoting that there are more and more such things which are going to come. So markets is into a guessing game right now. And plus on top of it, this is a period which has just coincided when people globally are turned slightly cautious on emerging markets. So you have 3 weeks in a row when the emerging market funds have seen pretty decent outflows versus the developed markets which have been outperforming. So I think first you have a general sense of underperformance in emerging markets, and then you have very India specific events which has led to the kind of fall that we have seen. Although I must say that after this 17-18% fall from the last 3-month high, at least you have started seeing a lot of the stocks and sectors which have started making sense.
Okay. Rajat, your thoughts? I mean, one wonders, it's quite curious that we got this bout of short covering, this rally that we had at the end of Friday's trade, on a day when the Q again was negative. This IIP number at 1.6% certainly wasn't looking any pretty. But do you think the market is still in the zone of technicals right now, where we are still flirting with rebounds here and there? Or do you think this is the beginning of the end, basically some kind of a bottom that's being formed?
Well, only time will tell whether this was the bottom or not, because we only come to know in the hindsight that few days back the levels that we saw was the bottom in the market. But I agree with you that the Qs continued to remain negative for India. The Qs were negative for the region also, and still India had a fantastic day today. But overall, I would think it will be too early before one starts calling it a bottom right now. Because till the time you start getting positive on both the things, first all these issues which have come and impacted the valuations of the market, and the core growth issues which has been primarily led by inflation and monetary tightening, you are not going to see any rally. You may see a phase when markets may not go down even when you see bad news, just because we are already down 17-18%. But for markets to go up, you will need this environment to turn better.
Okay, well, we're talking to Rajat Rajgarhia, head of research at Motilal Oswal, at the end of what's been quite a volatile and nerve-wracking week for all kinds of reasons, including the volatility in certain kinds of stocks. Rajat, at the end of this quarter, the evidence that you have before you, how are you finding growth rates as far as India Inc. is concerned? And are they meeting your benchmarks, or have you had any reason to pare down estimates, pare down perhaps stock price targets in some quarters?
Actually, if you look at the third quarter numbers, and we are still a couple of days left before we get the aggregates, but you almost have 90% plus of the universe that reported. The numbers have been quite okay. You have 23-24% growth for the entire universe, whichever universe you want to look at it. And when we look at our estimates for FY11 and 12, even though individual companies and sectors have seen variation in the estimates compared to what they were a month back, the aggregate EPS numbers for the market remains more or less unchanged. For example, this year we are still looking at a 26-27% growth for the index EPS, and for FY12 we still are at closer to 18-19% growth, which is a 1250 rupees EPS. So that's the beauty of the aggregate, that you may see downward bias in some of the estimates, but 2 or 3 big heavyweights come and overall make up the aggregate. Markets, however, will more be a function of how the breadth of the earnings and the composition of the earnings behave. For example, if you have some of the global cyclicals which drive up the numbers and some of the domestic economy plays which drive down the earnings, so for the same earnings you will see a lower multiple, which in turn would mean that the markets will trend lower.
So, I mean, from what you were saying, you're expecting next year the Sensex to give a growth return of about 18-19%. So what's the level at which then the index should quote at? What is the right multiple according to you for the market?
If you look at our multiple parameters, on an last 5-year, 10-year average has been a 14 times. Till a quarter back we were trading at 17 times. I think the best case would be that you see markets remaining here for another 3 to 4 months. You get confirmation about this 1250 rupees EPS of FY12, and as you keep on adding one more quarter of numbers, the market starts looking at around 13 and a half times. At 14 times you are just about at the fair valuation. 17 was excitement.
What about sectors, Rajat? What has stood out for you at the end of the quarter in terms of, where there is some kind of stability, some kind of expectation that you will have sustained growth in terms of numbers? And the other issue, you've had sectors like auto where the top line growth is great, but the market hasn't liked the fact that companies are finding it hard to maintain profits and margins.
Right. I think the sector which stood out in this quarter numbers was the one which led the fall into this market in the month of December and Jan, which is financials. The numbers that got reported from almost every financial was fantastic. Almost everyone reported better than the estimates, both at the core operating level and the reported profit level. That has given a lot of confidence to investors to start getting back into these names. So both. But
Rajat, allow me to interrupt over there, and I just want to understand this a little better. When we were going into results season, there was this huge paranoia around banks, whether they will see their margins contract because they've been hiking deposit rates and now FDs are available at 9%. None of that happened in this quarter at least, but then, there are people who say that it will come through in the last quarter and the first quarter of the next year. Do you think that's right? And if it is, should one be buying bank stocks right now?
Well, I think the forecast about the trend that most of the analysts make, that the margins will contract for these banks, is right. I think the level from which they think that the margins will contract is where they got it wrong. People thought that margins will peak out at 3.4 and will contract from there by 30 basis points. Margins have moved up to 3.7 and they will contract from there by 30 basis points. So your forecasted level is where the margins are now going to settle at versus the current level. That's point number one. Point number two, if you look into the P&L account of these banks, it's a function of multiple moving parts. And even if you see some contraction in margins, we are expecting a significant drop in the credit charges for these banks next year, which means that you will still get an earnings growth of 18-20%. And please remember, these banks today have their balance sheet and P&L account which is much better than what it used to be ever. So the multiples today will be always higher than what their averages have been. I think these are some fantastic times to again buy banks, both private and PSU, because this is one space which will keep on compounding earnings at 17-18%, and with some element of valuation re-rating you can definitely compound your returns much higher. Coming on autos, they had a pretty impressive performance whole of 2008, 2009 and partly 2010, when the stimulus, low interest rate, a lot of the income growth in the economy provided big boost to their volumes, and the commodity prices globally had crashed. Now I think you are first going to see the base impact on the volumes coming and hitting them, and second, surge in the commodity prices will make margins quite tough, at least into the competitive segments. That's why you have started seeing quite divergence in the performance of auto space. You have likes of Maruti and Hero Honda, which have a much higher underperformance compared to a Mahindra or a Tata Motors. So I think it's going to be a stock specific sector to play rather than taking a call on the entire sector to bet upon.
All right. Rajat, what are you telling your clients about infrastructure stocks right now? I mean, there's such a debate out there whether you should be buying, whether the multiples are still justified, or whether they're now looking attractive after the crash. What's your sense?
Stocks are definitely looking attractive purely on the valuations. Today, the key issue for investors to focus is how much drop in the earnings you are going to see for these companies next year. I must say that last 6 months have in particularly been quite headwinded environment, given that you are seeing tight liquidity, rise in rates impacting a lot of project creation. I think you need to take a call in the next 3 months whether FY12 is going to be a tough year for these companies from the business point of view, because first the budget, what kind of project creation happens. Second, all these events, monetary tightening, inflation, they need to settle by March. That would be a pretty good time to take a call whether these infrastructure stroke capital good companies come back in focus for FY12. Even after the big crash in the valuations, we are not expecting these stocks to again go up.
Rajat, final thought then on the budget. How important an event is it for the market this time around? I mean, we usually have started looking at the budget as only a statement of the government's intent or basic accounts, but this year is the expectation slightly more because of the way things have been?
Yes, I think given that this market has become so much macro right now, all macro events are going to have an impact, and budget would definitely have an impact because there are 3 things that investors will look forward to. First, what are the changes in the taxes and the duty structure, because at least in this headwinded environment, next year revenue growth collections becomes important first. Second, what's the stance on the subsidy, because at the current oil prices, subsidy etc. becomes pretty big for the government to budget. And third, what is the fiscal deficit, borrowing plan, and some of the any specific reforms that the government announced. We have heard about some noises to be made on GST etc. But I think primarily the 2 numbers that one would be looking at, first the fiscal deficit number, because at the current oil prices that could be big, and second, what are the assumptions for the revenue growth for FY12.
All right, Rajat, thank you for taking out the time, joining us this week. That's the point of view coming in from Motilal Oswal on the markets.